Good morning, ladies and gentlemen. I see the number of people joining the room is growing. Welcome to a webinar jointly organized by Istituto Affari Internazionali, IAI, SIP, and the International Energy Agency on gas market developments and outlook. This webinar has the privilege to host the premiere launch of the new IEA Gas Quarterly Report for Q1 2024. My name is Luca Franza. I'm scientific advisor at IAI, and as per tradition, I'm joined here this morning by Kobe van der Linde, director of SIP, and our favorite guest analyst, Gergely Molnar from the IEA, a very popular face to our aficionados and key person behind the IEA's quarterly gas reports for many years, who has enlightened the community with deep knowledge and sharp analysis. So for those of you like me who live in Northwest Europe, the past weeks have been somewhat puzzling. You'd open the window and see snow, you switch the TV on and watch news of attacks on a major sea lane for LNG, and yet heard nothing about high gas prices nor looming gas prices. I am, of course, referring to instability in the Red Sea and even fears for further regional escalation that may affect Hormuz, a key transit point for Qatari LNG. In spite of these events, prices have kept on declining in Europe. Of course, there are ups and downs, but more or less, I would say, since mid-October, we have been on a pretty consistent downward path here in Europe when it comes to gas prices. And in other key gas regions, prices have gone down too. This is not the first time that we see somewhat peculiar seasonal dynamics. Last year, actually, the central winter months were also months that saw declining gas prices relative to the previous months, even if, of course, 12 months ago, gas markets were much more tense and volatile. So what is going on? Well, there is a standard explanation that I hear, and I'm curious to see actually if Greg confirms it or challenges or perhaps nuances and integrates it. Unsurprisingly, the explanation that I hear goes that this steaming paradox is due to, of course, as usual, a combination of factors. The straits, has to be noted, play a very different role because while a disruption of traffic through Hormuz would be quite catastrophic, instability in the Red Sea has so far resulted in longer voyages for cargoes to Europe, yet no widespread disruption. Another factor is that there are weak economic fundamentals pretty much everywhere, and actually interest rates remain quite high in some key gas-consuming regions, depressing the economic outlook, which is something that, of course, gas market operators look at. Other factors, the fact that cold snaps were actually quite short-lived. There's food storage, storage filling rates are very high, not only in Europe, but also in Asia. Industrial demand is not yet back to pre-crisis levels. And if we look at the power sector, we see pretty good nuclear output in France, in Japan, and you really start seeing gas savings from massive RES scale up. And here, if you allow me, Greg, I also want to advertise a bit the renewable report that the IEA put out a couple of days ago, which is excellent. And of course, on the supply side, we've seen robust supply in the US. The implication of these pretty contained gas prices for the energy system are quite important. First of all, we see that electricity prices seem under control. Let's not forget about the panicked debate about the gas-electricity price correlation last winter, and the political debate that emerged from it of the necessity to decouple gas prices from and electricity prices. CO2 prices are also quite low, and at least here in Europe, you actually start hearing concerns about this in terms of what signals we are sending to investors that want to decarbonize. But okay, let's also look ahead. So if we look ahead, I think what's really interesting to look at is what happens to demand with these relatively low prices. So will demand pick up on the back of prices? And you have data here in Europe showing that if demand in the EU goes back to pre-crisis levels, we would have prematurely depleted storage and probably also supply crunch. So here the question is really, can we afford in Europe to go back to pre-crisis demand levels, and how will demand develop on the back of low prices? I'm wondering in general how and to what extent we will see international demand grow in the next few months, and to what extent this will happen in waves. At the same time, usually supply also comes in waves. So we might see periods where you have oversupply and periods that are undersupplied. All in all, the figure that I saw, but we will hear more from Greg, is that we'll have about 250 billion cubic meters per year of new liquefaction capacity set to come online by 2030, most of it coming online in the window between 2025 and 2027. However, at the same time, you must have all read recent news that gained quite a lot of attention, that the US is taking a more cautious approach to authorizing new export terminals, as the Biden administration is directing the DOE to evaluate the climate impact of approving export terminals. So this might have an impact on future volumes, although probably more towards the end of the decade and even beyond. With regards to Europe, again, looking ahead, a lot of the emergency measures that were introduced during the crisis have been mirrored in permanent legislation, but most of these measures are of a voluntary nature and or triggered in case of a crisis. Interesting to watch provisions that are enshrined in the gas package, on which an agreement has been found, that allow European countries to stop Russian gas imports. And this would have, of course, if countries decide to trigger this legislative option, would have a potential impact, especially because of the role of Russian LNG now in the European market. In these days, the discussion is also dominated by some of the legacies that we face from the crisis. It's not really in the public debate, but it's set to gain importance, such as, for instance, measures that some countries are introducing to recover the very high cost of refilling the gas storages in 2022. The next years, again, looking mostly at the Brussels bubble here, will be key also to understand the impact on gas imports that the recently agreed upon European methane regulation will have. And of course, last but not least, something that is very much to watch is the publication of the 2040 targets by the European Commission on the 6th of February. We have already seen some previews of numbers that are projecting very low gas consumption in Europe by 2040. However, we will see only in the next months and years actually how those numbers that will be part of a non-binding communication will be translated into law by the European institutions, because that will depend a lot also on the outcome of the European election in June. So we will hear more from Greg about the numbers, about recent developments, but also the outlook. I would like to encourage all of you to already post your questions in the dedicated Q&A section. And I would like to give the floor to Greg to share his presentation. And by the way, very happy to see almost 200 people connected at this point.
Thank you, Luca, and for this wonderful introduction. And good to see you. Happy New Year to all of us. We can kickstart the presentation of our latest quarterly gas report, which had been just published about half an hour ago on our website, and it is of course available free of charge to all who are interested in the very dynamic and very quickly evolving natural gas markets. The presentation will be really structured around three key topics. First, we will look at the global picture. Then we will focus a bit more on the European market. And last but not least, we will also discuss some of the recent policy and market developments related to low emission gases. Now, let us start with this, let's say, classic chart, which shows the evolution of natural gas prices across key regions. We have TTF for Europe, JKM for Asia, and the green line, Henry Hub for the United States. And I think that what is really key here is to see this very steep decline in natural gas prices compared to the all-time highs reached in 2022 across all the key markets. When we are looking at TTF, gas prices here averaged at about 70% below their 2002 levels, and actually JKM followed a similar trajectory. And when we are looking at Henry Hub prices, they declined by about 60% to around $2.7 per MMBTU, which is very well in line with the historic averages for the period 2016-2020. So what we see is, that gas markets have moved towards a gradual rebalancing in 2023, and this has been really due to the combined effect of timely policy action, effectively working market forces, and of course, mild winter weather conditions across the northern hemisphere. But I also would like to note that while the European and Asian prices have moderated down significantly, to around $13–14 per MMBTU in 23, this is more than the double of their 5-year average during the 2016-2020 period. So this means that natural gas prices remain relatively high. And also, if we compare, the gas prices in Europe to the gas prices in the United States, they are about 5 times higher, which raises, some questions also regarding the competitiveness of the European gas-intensive and energy-intensive industries. And I think it is also important to note that this moderation in market tensions happened despite the fact that from a supply perspective, the market has remained fundamentally tight. And the reason for that is that we have seen only a very limited increase in LNG supply, about 13 BCM, which was of course not enough to offset the reductions in Russia's pipe gas supplies to Europe, which declined by about 38 BCM compared to 2022. So in this context, the demand side has been really the driving force behind this easing market tensions. On this slide, we are showing how natural gas consumption evolved in the key import markets of Europe, some of the major Asian markets, China, and the fast-growing Asian markets, as well as South America. And I think that what is the key takeaway here is that the demand reductions recorded in Europe, in the major Asian markets, have been really, really important in softening up, in loosening the market. And this has been due to a combination of weather-related factors, but also the rapidly rising renewables and improving nuclear availability, especially in the case of Japan. But we also see on this slide that natural gas markets, in a way, returned to growth in the second half of the year, with the notable exception of Europe. And this has been partly enabled by the lower price environment we have seen starting to emerge in the second half of the year. And of course, as we can see on this slide, this demand recovery is very much driven by China and the fast-growing Asian markets. Now, moving to this slide, we are here presenting a more complete assessment of natural gas demand dynamics in 2023. And I think that if we focus on the first bar, we show that in our estimates, global gas consumption increased marginally by 0.5 or 20 BCM in 2020 in 2023, and we also see that there have been quite some movements across the sectors. When it comes to the residential and commercial sectors, the unseasonably mild weather conditions across the northern hemisphere, as well as gas-saving measures, have been, of course, lowering gas use in buildings. But this has been, in a way, offset by higher demand in the power sector, as well as demand recovery recorded in the industrial sectors, as well as in energy own use, including refineries. But I think it is also important to note that the 0.5% growth was not enough to offset the 1.5% decline recorded in 2022. So in 2023, gas demand has been still lower than it has been in 2021. And when we are looking at which regions have been driving this demand growth, we have here, of course, North America, where we have seen a very strong, very robust growth in gas-to-power demand, which has been driven partly by coal to gas switching dynamics. We estimate that gas-fired generation in the United States increased by 6.5%, and the share of natural gas in the power mix increased to an all-time high of 43%. But this growth has been almost entirely offset by the steep demand reductions recorded in the residential and commercial sectors, because we had quite mild winter weather conditions across North America, both in Q1 and the fourth quarter of 2023. When we are looking at the Asia-Pacific region, our estimates indicate that following the 1.5% decline in 2022, gas markets here returned to growth and increased by an estimated 2.5%. And this has been very much driven by the two major markets in the region, China, where natural gas consumption increased by 7%, and India, where it increased by about 5%. And in both cases, it has been mainly driven by the industrial sector and to a lesser extent by gas-to-power demand. In the Middle East, natural gas consumptions continue to increase, enabled by the region's rising gas production, and most of that is actually concentrated in industry as well as in the power sector, where it enables continued shifting away from oil-based power generation. And when we are looking at Eurasia, it has been, again, I would say, a combination of recovery from the very low 2002 levels, partly enabled by higher gas burn in the power sector amidst lower hydro and nuclear availability in Russia, as well as recovery in industrial gas demand. In Africa, gas demand growth is largely driven by higher use in the power sector. And then we have Europe, and we will discuss Europe in greater detail in a couple of minutes. But here I just would like to highlight that demand continued to decline and have fallen by about 7% or 35 BCM in 2023. And of course, in Central and South America, healthy hydro availability has been weighing on gas burn in the power sector, and as such reduced marginally natural gas demand in that region as well. If we are moving now to the forecast, on this slide, we are showing gas demand growth by regions. And in our latest forecast, natural gas demand will grow by 2.5% or 100 BCM in 2024. And the Asia-Pacific region is expected to account for approximately 40% of this demand growth. But as we can see on this slide, all the different regions are contributing actually to that growth, including Europe and Central and South America. But I think that one fundamental question is how much of that growth is really structural. And on this slide, we are, trying to respond to that question. In a way, we are looking at our forecast by region and by sector. As we can see on this slide, approximately 40% of the expected demand growth is coming from the residential and commercial sectors. And the most of that is actually driven by the assumption that we will return to average weather conditions after an unseasonably mild 2023. And then, of course, on the top of that, we have the different gasification programs which are being undertaken in Iran, China, and Russia, which also add a couple of BCM to RASCOM demand. But most of that is really driven by our assumptions on average weather conditions. And then the second big growth driver is industry. And here it is mostly concentrated in the Asia-Pacific region as well as the Middle East and Africa, the two regions which benefit from a relatively low gas prices. And industry actually accounts for almost 1/3 of incremental gas demand in 2024. But it is also important to highlight that we expect that some of that demand growth will be actually be the result of the recovery from the 2022-2023 gas supply shock, mainly in Europe and in some of the most price-sensitive Southeast Asian markets. And then we have the third category, which is the power sector. And here, we see very different dynamics across regions. Globally speaking, gas to power demand is expected to increase by less than 1% in 2024. And this growth will be very much driven by Asia, North America, as well as the Middle East and Africa. But some of that growth is expected to be offset by the demand reductions we foresee in Europe and the major Asian markets. And this is because in those regions, we foresee improving nuclear availability and a continued strong expansion in renewables. And then we have the last category, which is the others. This includes transport as well as energy own use, including refinery. Here again, this is mainly driven by higher demand from Asia and Middle East, as well as some recovery from Europe. Now, I think it is important to highlight that this expected demand growth will be also enabled by the gradual recovery in global gas trade. On this chart, we are showing the main channels behind global gas trade, which includes Europe's pipeline imports, China's pipeline imports, as well as global LNG supply. And as we can see here, after two quite difficult years, the 2022-23 gas supply shock, global gas trade is set to grow again. And this is primarily driven by higher Russian pipe gas deliveries to China via the Power of Siberia pipeline system, as well as an increase in global energy supply. But it is important to put this into context. Our forecast indicates that global energy production will increase by a mere 3.5% or 18 BCM, which is well below the 8% growth rate we have experienced between 2016 2020. So this, in a way, will also cap the demand growth in the key Asian and European import markets. And on this side, we would like to give a bit more focus on the drivers behind energy production growth. Last year, it has been really a US-focused story because the United States accounted for about 80% of energy production growth in 2023. Now, this year, the picture is a bit more diverse. North America is expected to solidify its position as the world's largest energy exporter. Freeport LNG plant is expected to continue to ramp back to its pre-fire levels. But we have also Altamira FLNG coming online in Mexico and being fed by US gas. And we also expect Plaquemines LNG to come online towards the very end of the year. But the second very important contributor to natural gas, to LNG supply, is actually Africa. And this is a story of improving feed gas availability, including in Egypt and Nigeria, as well as the ramp up of new facilities. Tortue FLNG in the second half of 2024, as well as Congo FLNG, which actually just shipped its first LNG cargo. We also expect, incremental LNG supply coming from Indonesia, from the Tangguh LNG Train 3 facility, which was commissioned at the very end of 2023. And we also expect additional LNG supplied from Russia, which is partly due to the lower maintenance at the existing facilities. Sakhalin and Yamal LNG both underwent very heavy maintenance periods last year. So there will be some recovery from there. But we also expect some incremental LNG supply coming from the Arctic LNG 2 plant. Of course, there is a number of uncertainties around that supply due to the sanctions regime. And this brings, in a way, us to one reflection, maybe around our outlook. One of the major risks to this outlook is actually geopolitics. Geopolitics and gas markets, gas infrastructure are making a rather bad romance. And here on this slide, we are showing just a couple of examples about the negative impacts of geopolitical tensions on gas infrastructure. I'm not going to enumerate all of them. I think that all eyes are at the moment on the Red Sea crisis, which of course disrupts LNG trade. It does not lead to a curtailment in production, but it leads to suboptimal shipping routes. It is increasing voyage times. Just to give us an idea, it takes about 10 more days to ship one LNG cargo from Ras Laffan to Gate in the Netherlands via the Cape of Good Hope than it would have been through the Red Sea. So, of course, geopolitics is a major uncertainty for this outlook, and also is a stark reminder that gas and energy supply security issues should remain at the forefront of policymakers, despite the easing of the market tensions we have seen in 2023. Now, in the next couple of minutes, we would like to focus a bit more on the European market. This slide gives us a bit of a long-term historic perspective on how natural gas demand evolved in OECD Europe. But what I really would like to put into perspective is that this very steep decline we have witnessed in the last 2 years, when natural gas demand in Europe declined by about 20%, or just over 100 BCM. And actually, European gas consumption have fallen to its lowest level since 1995. And this slide gives us a bit of, more granular breakdown of the drivers behind this demand reduction. In 2022, European gas consumption declined by about 13%, or 70 BCM, and most of that demand reduction was concentrated in the industry and the residential and commercial sectors. When we are looking at 2023, the picture is slightly different, because we have seen that in total, European gas consumption declined by about 7%, or 35 BCM. But about 75% of this demand reduction was due to the power sector, where the rapidly rising renewables and improving nuclear availability in France reduced the call on gas-fired power plants. I think it is also notable that in Europe, we have seen in industrial gas demand some recovery happening in the second half of 2023. Of course, this recovery is quite fragile and hugely dependent on the evolution of natural gas prices. And we also continue to see demand reductions in the residential and commercial sectors, where demand have fallen by about 10%. And this has been mainly due to actually non-weather related factors, such as energy efficiency, behavior changes, and also rising affordability issues for some of the European households. On the second part of this graph, we are showing our forecast for 2024. And in our forecast, we do expect that gas to power demand will continue to decline in 2024 by about 10%. And this is due to a combination of efficiency gains, the expansion of renewables, and improving nuclear availability. But this decline will be more than offset by higher space heating requirements, assuming the return to average weather conditions, and also an expected recovery in industrial gas demand if the current price environment holds for the year. And altogether, we do expect that European gas demand will increase by about 3% in 2024. But of course, this is not enough to offset the steep demand reductions we have witnessed in 2022 and 2023. Actually, European gas demand will remain about 17% below its 2021 levels in 2024. Now, this slide is focusing a bit more on the supply side. LNG really solidified its position as Europe's new baseload source in 2023. Historically, LNG accounted for just about 10% of Europe's primary gas supply. Its share has steeply increased to about 1/3 in 2022 and further rose to an all-time high of 37% in 2023. And this has been partly due to the lower Russian pipe gas deliveries, which now account for just 10% of Europe's primary gas supply mix. Looking ahead to 2024, we do expect that because of this moderate, very moderate recovery in European gas demand, LNG imports will increase marginally compared to 2023. And we also assume a higher Norwegian deliveries to the European market after a quite heavy maintenance season in 2023. Now, this slide is just, a quick look at where we stand in terms of storage levels. On this slide, we show that at the moment, EU storage sites are about 70% full and are standing 20 BCM or 20% or 12 BCM above their 5-year average. And of course, these high inventory levels do provide us with a safety buffer for the remainder of the heating season, and they can also reduce the injection demand during the upcoming summer season, and as such contribute to less market tensions through the year. Now I would like to move to the last part of this presentation, which is on low emission gases. Maybe a footnote to that. About 1 year ago, we launched at the agency our low emission gases work program, which is really focusing on the short and medium term policy and market developments related to biomethane, low emissions hydrogen, as well as e-methane. And I think that one point we would like to highlight here is that low emission gases are benefiting from a very strong policy momentum, which is highlighted by all the different policies, initiatives, strategies, and regulations which have been launched or enacted in 2023, not only in Europe, not only in North America, but also in some of the Asian markets. In January of this year, India published its National Green Hydrogen Mission, which aims to scale up low emission hydrogen production to 5 million tons by 2030. This has been followed by an updated version of Japan's basic hydrogen strategy, which aims to develop a domestic hydrogen market of 3 million tons by 2030 and to scale it up to 20 million tons by 2050. But we also have seen some new initiatives launched in the United States, which published its National Clean Hydrogen Strategy and Roadmap in June. And this has been followed in October by the announcements of $7 billion US funding for 7 regional clean hydrogen hubs in the United States, which together could scale up low emission hydrogen production in the States to 3 million tons by 2030. And also maybe to mention that on the biomethane front, in the United States, the Environment Protection Agency adopted more stringent fuel standards, which will enable a quite robust growth for biomethane use in the transport sector. And we have seen also India, which announced blending targets for compressed biogas towards the end of this decade, which will also benefit compressed biogas production in the country. And now, maybe a couple of announcements from Europe. Of course, the European Hydrogen Bank has been launched, a new financing instrument, which is now aiming first domestic projects with the first auction had been carried out at the end of 2023, but also a compromise had been reached at the EU level on the hydrogen and decarbonized gas markets package, which really lays down the regulatory foundations for hydrogen and low emission gases market in the European Union, and which foresees the operational framework for low emission hydrogen transmission networks, which should be organized in an entry-exit system, similarly to what we have in the gas market, of course, with some time of adjustments towards 2030. On this slide, we are showing our latest estimates related to biomethane production, which in our view increased by about 10% or 0.8 BCM in 2023. Most of this growth, about 80%, has been concentrated in Europe and North America. In the United States, biomethane output increased by around 10%, and this in a way solidifies the US leading position as the world's largest biomethane producer. In Europe, biomethane production growth has been really led by two markets: Denmark, where output increased by 15%, and this also brings the share of biomethane in the total Danish gas supply to 38%, which is of course a record, and which in a way shows that biomethane is a major technology and a fuel which can be scaled up with the right configuration of the gas system, with the right support mechanisms and policies. The other strong growth market is France, where biomethane production soared by 30%, and this indeed puts France to become Europe's second largest biomethane producer, next to Germany. Besides Europe and North America, we also see that some other biomethane producers are emerging. This includes India, but also we are keeping a close eye on Brazil, which has a huge potential for biomethane production, and recently some new support schemes have been adopted, which are giving hope that Brazil can realize its potential in biomethane production. One other low emission fuel I would like to bit focus on is e-methane, or synthetic methane, which is produced by low emissions hydrogen, adding to it a carbon source. Now, in contrast to low emission hydrogen, e-methane is perfectly interchangeable with natural gas, and as such, its integration into the gas system does not require any repurposing, any retrofitting of the gas infrastructure. And Japan is one of the players which is very actively advancing the development of international e-methane supply chains. On this slide, we are showing some of the major non-binding legally non-binding agreements which have been signed mainly by Japanese companies with large energy producers in the US, in Australia. And what we see is that if these proposals come to fruition, by 2030, global e-methane trade could reach 1 BCM by 2030. Of course, there is a number of challenges related, including the very high cost of this fuel. I would like to stop here and thank you, first of all, for your kind attention, and thank you.